Today's big question is, what do some of the greatest investors of all time think about index funds? We'll be featuring videos clips from across the years from legendary investors such as Warren Buffett, Jack Bogle, Charlie Munger, and Joel Greenblatt. In case you're unsure, an index fund is a type of mutual or exchange traded fund that tracks the performance of a market index, such as the S&P 500, by holding the same stocks or bonds. Make sure you watch to the end of today's videos because we're going to start off with some real positives from our investors, and in the end they're going to discuss the potential negatives of index funds too.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never, never, never be in or out of the market. Always be in at a certain level. You may want to be 50% in the stocks like I am. You may want to be 75% or 25%. That's probably a decent range. But never be out and think you can get back in, because your emotions will defeat you totally.
One of my favorite Jack Bogle lines is when somebody says buy and hold is dead, or when they ask you, is buy and hold dead, what do you say? You always say, depends on what you buy, right?
Well, buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leave aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google. Maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20. So, you're making a good long-term bet, but short-term betting is just not a good way to go.
Another issue, of course, that's happened in the world of stock picking, where all this money and effort goes into trying to be rational, is that we've had a really horrible thing happen to the investment counseling class. And that is, these index funds have come along and they basically beat everybody. And not only that, the amount by which they beat everybody is roughly the amount of cost of running the operation and making the changes in investments. So you have a whole profession that is basically being paid for accomplishing practically nothing.
The reason that the wave to passive is really here to stay, whether there'll be some little travels up or down over time. Big picture, I gave a talk at Google a few years ago, and I started it this way. Even Warren Buffett says most people should just index. And then I said, I agree with him. And then I left. No, then I said, but then again, Warren Buffett doesn't index, and neither do I. How come? And so there's a big dichotomy. If you don't know what you're doing, the safest thing to do is to index. Investing in stocks is really about valuing businesses and try to buy them at a discount. Your other alternative, if you can't do that, your other alternative is to find a manager who has a good process and sticking with that. But I wrote a book a number of years ago, I think in 2011, called The Big Secret. And my line is always that it's still a big secret because no one bought that book. But in it, I talked about the best performing mutual fund for the period 2000 to 2010. And that fund was up 18% a year. But the average investor in that fund, the market was flat during that decade,
right.
So up 18% a year was pretty good. The average investor in that fund managed to lose 11% a year on a dollar-weighted basis by moving in and out at all the wrong times. After the market went up, people piled in. After the fund outperformed, they piled in. After the market went down, they piled out. Or after the fund underperformed, they piled out and turned that 18% annual gain into an 11% dollar-weighted loss. And that's just the way people are. If you don't know what the manager is doing, you look at past returns. But there's been plenty of studies showing the last 1, 3, 5 years don't have much to do with the next 1, 3, 5. And really what you're supposed to do is look at process and finding a good manager and assessing that. Most people don't have that skill set either. I think the good news is that if most people just index, if you're a stock picker and actually do the work, there's less competition.
Yep.
And I think that'll be helpful as a stock picker long term. But the active management business will still continue to be threatened.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
At the annual meeting for Berkshire Hathaway this year, you introduced a special guest to the audience of 40,000 shareholders who were watching. It was Jack Bogle. Why did you want to recognize Jack Bogle?
I think Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he, with a number of other people, he came up with the idea of the index fund. He wasn't the sole thinker behind it, but he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives. They're going to have better retirements. Their kids are going to inherit more money because of Jack Bogle and his efforts.
So far, our great investors have been very positive about index funds, but there are some questions about them. And in the following clips, our legendary investors are going to discuss the potential negatives. If you've enjoyed this video, please remember to like, comment, and subscribe.
Jack, how do you answer the criticism when I saw your interview with Barron's recently about the critics of the index fund today saying that you're not allocating capital properly? It's because the biggest stocks make up the biggest percentage of most of the indexes, like Microsoft is 3.2% of the S&P 500, while Walmart is 0.5%. So new money going into the index fund means that these already large stocks take a proportionally more money than other stocks. So is that destabilizing?
That's not only not destabilizing, Maria, it's not true. In other words, if we have 4% of assets in Alphabet or Google, we put 4% of our new money into that. If we have 0.5% in Walmart, as you said, we put 0.5% in our new money. It doesn't change the equation. We're investing based on the market values of the company. And when the prices of those companies go up, the prices go up in the regular market, if you will, by individual investors, but they also go up for the index fund.
Okay.
So rising prices creates zero capital allocation issues.
But do you also subscribe to the philosophy that if you can invest with Seth Klarman, that you should actually be investing in index funds, and that's the safer and best path?
You know, the argument for index funds is that you're going to have low transaction costs near zero, and you're going to have exposure to the market. You're not going to underperform the market, but neither will you outperform the market. I think for the average person out there who isn't terribly sophisticated and is able to take a long-term view, I don't see anything wrong with index funds. But I think one of the critical things about the long-term return from investing is that it depends on the entry price. So if you enter when the market's very expensive at a high valuation, you may be disappointed because you might match the index, but the index may not do very well from there. So the other thing is you don't want to go into index funds, experience a bad market, and then bail out. That's what investors tend to do. Right. They get in at the wrong time and they get out at the wrong time. And so investors who go into index funds should go in with the idea that they're going to stay through thick and thin.
I think his second worry is that common stocks could become so high-priced that if you bought index funds, you wouldn't expect to do very well. I didn't think I'd live long enough to think that was likely to happen, but now I think that may happen.
But probably what you're saying there is that they could get to a level and they'd have to be at a sustained level like that for a long time.
They could be there and stay there for a long time.
In which case you might make 3 or 4%. But would there be anything way better than that around under those circumstances anyway? And pass the peanut brittle, please.
Well, in Japan, where something like this happened, the return from owning a nice index over the last 13 years or so is negative. Can something as horrible as that happen here? I mean, is it conceivable? I think the answer is yes.
But the option in Japan, of course, is to have deposits in a bank or own Japanese bonds at somewhere between 0 and 1 or 1.5%. So
hopefully from today's video clips, you got some interesting insight into index funds. It all seemed pretty positive, didn't it? And I did try and find some negative videos to keep things a bit balanced, but it's very difficult to find negative videos on index funds. So please do remember, if you are going to invest in such products, to do your own research. That's really important. If you have any thoughts on today's video, or just let me know in the comments. I'd really love that. And if you could support the channel by liking and subscribing, that would be much appreciated as well.